Marcus is not doing anything that looks impressive. Walk into his apartment on a Tuesday night, and you'll probably find the place quiet. The dishes are done. The slow cooker is still warm on the counter, and he's probably asleep before 10. There is no stock chart open on his laptop. No finance podcast playing in the background. No panic research about some company that might triple next year. His 401k contribution was set months ago, and he hasn't touched it. His brokerage account went up $67 last month, but he doesn't know that yet because he hasn't checked. And honestly, he doesn't need to. Now, walk into Derek's place. Derek is awake at 1 a.m. His phone is 6 inches from his face. He's watching a video about a biotech stock someone mentioned during dinner. He opened an investing account 8 months ago, and he has already moved through multiple funds, a few individual stocks, and one investment he didn't fully understand but bought anyway because the chart looked exciting. His account balance is around $2,200. About $1,900 of that is money he deposited himself, which means after 8 months of investing, all the movement, all the research, all the second guessing, all the checking his phone has produced about $300. And now he's starting to think the entire thing is rigged. But Derek is only half wrong. The system is frustrating. It does feel slow. It does feel like compound interest is something people talk about more than they actually experience. But the problem isn't that compound interest doesn't work. The problem is that compound interest is almost invisible when your balance is still small. That's the part nobody likes to explain. Financial charts usually show you the full 30-year picture. You've seen them before. The line starts low, moves slowly, then suddenly shoots upward like a rocket. That curve makes wealth building look obvious, inevitable, and exciting. But those charts skip the emotionally difficult part. They don't show you year 3 when your account still feels tiny. They don't show you year 7 when most of the money in the account is still money you personally contributed. They don't show you year 8 when your investment account basically feels like a savings account with extra steps. My name is Trey, and I spend way too much time thinking about improving my money mindset. Because here's the truth. In the early years of investing, your contributions matter way more than your returns. Let's use real numbers. Assume an 8% annual return with monthly compounding. That is not some fantasy number designed to make the chart look pretty. It's a reasonable long-term assumption for stock market investing, even though actual returns will move up and down from year to year. Now let's say you invest $50 a month. After 10 full years of never missing a contribution, your account would be worth roughly $9,200. Of that, about $6,000 came directly from your own deposits. Compound interest added around $3,200. That sounds nice until you break it down. That's about $320 a year from compound growth, around $26 a month, after an entire decade. That's why so many people quit mentally before the system ever has a chance to work. They hear compound interest described like a wealth machine, but when they look at their actual account, it feels underwhelming. Now increase the contribution. At $200 a month, using the same 8% return over the same 10 years, the account grows to around $36,800. At $400 a month, it grows to around $73,700. The return didn't change. The time period didn't change. The only thing that changed was the monthly contribution, and the result went from about $9,200 to more than $73,000. That is the first major lesson. When your balance is small, the biggest lever is not picking the perfect investment. It's getting more money into the account. Now, let's stretch the timeline to 30 years. At $50 a month, even with 8% returns, your portfolio does not cross $100,000. After 3 full decades, it ends up around $74,500. That is not nothing. It is still progress. But it is not the retirement miracle people imagine when they hear the words compound interest. 3 decades of discipline at that contribution level still may not cover even 2 years of average household spending. That is not a character problem. It is a threshold problem, and the threshold is usually somewhere around $100,000 to $150,000 invested. Below that level, you are still doing most of the work. Your deposits are the main engine. Your returns are helping, but they are not yet powerful enough to change your life in a way you can really feel. Above that level, the math starts to behave differently. Your money starts producing enough growth that it feels like it has joined the team. This is where most financial advice gets sloppy. It treats every stage of investing like the same process. It gives the same advice to someone with $3,000 invested as it gives to someone with $300,000 invested. But those are completely different worlds. A person with $3,000 invested does not need to obsess over whether they got a 7% return or a 9% return this year. That difference barely moves their life. A person with $300,000 invested feels that difference. A 2% difference is $6,000. That's real money. So when you're early, the question is not, how do I find a better return? The question is, how do I reach the threshold faster? Think about a turbocharger in a car. A turbo uses exhaust gases to spin a turbine, which forces more air into the engine and creates more power. It takes something the engine already produced and feeds it back into the system to create even more output. That is basically compound interest. Growth creates more growth. But here's the part people forget. A turbo does not really do much at low RPM. It might be attached to the engine. It might technically be part of the system. But until the engine reaches a certain speed, there is not enough pressure to make the turbo feel powerful. Investing works the same way. When your account balance is small, the compounding is technically happening, but it does not feel powerful yet. You are the engine. Your monthly contributions are the fuel. Your returns are real, but they are not large enough to carry the load. Then, eventually, the balance reaches a point where the returns start becoming meaningful. The turbo kicks in. At $400 a month with an 8% return, you could cross $100,000 around year 14. After that, your investment growth starts becoming more noticeable. The return line begins to compete with the contribution line. That is when investing starts to feel different. But before that point, you have to survive the boring years. And the boring years are where most people make expensive mistakes. They get to year 5, year 6, or year 7. Their account is growing, but not dramatically. Most of the balance still came from their own deposits. They look at the numbers and think, this isn't working. So they start chasing. They move from index funds into individual stocks. They buy whatever someone at work mentioned. They start watching videos about companies they had never heard of 2 weeks earlier. They sign up for newsletters. They start believing that the problem is their return rate. But in phase 1, the return rate is usually not the main issue. The main issue is contribution rate. Let's prove it. Say you invest $200 a month for 10 years at 8%. You end up with around $36,800. Now imagine you somehow double your return to 16% per year for 10 years. That is extremely hard to do consistently. Most professional investors cannot pull that off for a decade. But let's pretend you do. At $200 a month and 16%, you end up around $52,200. That's better by about $15,400. Now, compare that to a much simpler move. Instead of chasing a 16% return, you keep the boring 8% return and increase your contribution from $200 to $350 a month. Now, after 10 years, you end up around $64,000. More money, less risk, less stress, no panic, no guessing, no complicated strategy. That is the point. When your balance is small, increasing contributions beats chasing returns more often than people want to admit. But nobody gets rich selling you that sentence. There is no flashy product called contribute more and wait. There is no exciting thumbnail for increase your automatic investment by $50. There is no newsletter built around own the market and stop touching it. So the finance world keeps you focused on the exciting lever, even when the boring lever is the one that actually matters. And the exciting lever can hurt you. Studies of investor behavior have shown again and again that individual investors often underperform the very funds they invest in. Not because the funds are bad, but because people move in and out at the wrong times. They sell when they're scared. They buy after something has already gone up. They confuse activity with progress. In the early stage, doing less is often the smarter move, not because you're lazy, because unnecessary action creates unnecessary mistakes. Marcus understands this, even if he wouldn't explain it that way. He doesn't check his account every night because there is nothing useful to do every night. His contribution is set. His investments are simple. His job is to keep the system running. Derek, on the other hand, is trying to solve a contribution problem with activity. He wants the account to feel bigger now. He wants compound interest to be exciting immediately, and because it isn't, he assumes the issue is the investment itself. But the real issue is that the balance has not reached the point where compounding becomes visible. So what actually moves the threshold closer? There are 3 simple mechanisms. First, increase your contribution by a small amount now. Not after you completely rebuild your budget. Not after the perfect month. Not after you feel ready. Just log in and increase the monthly investment by $25, $50, or whatever number is realistic. An extra $50 a month invested over 20 years at 8% can become close to $29,000. That is not from a life-changing sacrifice. That is from one small decision repeated automatically. Second, whenever you get a raise, redirect part of it before you get used to spending it. This is one of the most powerful habits in personal finance. If your take-home pay increases by $400 a month, you do not have to invest all of it. Let your lifestyle improve a little. Enjoy some of it, but redirect part of it immediately. Put 50% of the raise into investments before the new money becomes normal. Because once higher income blends into your lifestyle, it becomes very hard to pull back. But if you automate the decision before the first bigger paycheck lands, you never feel the loss. Third, when a recurring debt payment ends, redirect part of it the same day. This might be a car payment, student loan, personal loan, or any monthly obligation that finally disappears. The mistake most people make is waiting. They say, I'll enjoy the extra money for a little while, then I'll invest it. But money without a job gets absorbed. It disappears into convenience, takeout, subscriptions, upgrades, and random spending that nobody remembers later. So when that payment ends, immediately move part of it into investments. If a $500 car payment ends, maybe you invest $250 or $300 and keep the rest for flexibility. You still feel a lifestyle improvement, but you also move your threshold date forward. This is not about deprivation. It's about designing the flow of your money before lifestyle inflation gets there first. That is the difference between Marcus and Derek. Marcus is not smarter. He is not more exciting. He is not watching markets more closely. He just built a system that keeps moving even when he is asleep. His contributions happen automatically. His increases are planned. When his car loan ends, he already knows where part of that money is going. He does not need to make a new decision while holding extra cash. The decision has already been made. Derek is still trying to create progress through intensity. He reads more, checks more, trades more, worries more. But unless he increases the amount going in, his account may never reach the point where compounding becomes powerful enough to feel real. That is the hard truth. Compound interest works, but it does not rescue a low contribution rate quickly. It rewards time, consistency, and enough fuel. So if you feel like investing is moving too slowly, the answer might not be a better stock, a hotter fund, or a more complicated strategy. The answer might be much simpler. Increase the contribution. Automate the habit. Stop interrupting the process. Reach the threshold faster. Because once the balance gets large enough, the system changes. The returns start to matter more. the account begins to build momentum. The boring years start paying you back. And one day, your statement looks different. The growth line gets bigger. The contributions are no longer doing all the work. Your money is finally producing enough motion to feel like a partner instead of a passenger. That is when the turbo kicks in. But it only happens if you keep the engine running long enough to get there.